Welcome back to the Video CPA. I'm Michael Scott. I'm a CPA and a CMA with about 46 years of tax experience. So it's good to be with you today. Today we're going to be talking about the dependency exemption, which is usually pretty straightforward, but it can be kind of complex if you've had a divorce situation or something like that. So we're going to talk about it in more detail. So let's get started. We'll go through our affiliate marketing disclaimer that says if you touch a link on our site, go to a merchandiser and buy something from them, we get a commission, okay? And we just have to disclose that. And then there's our educational disclaimer that says, hey, we do our best to make these things right, but you need to study it out as well. So those are standard. If you've been on this channel before, you've seen them before. All right. So let's look and see what a dependent is as defined by the IRS, okay? And the IRS really says, hey, you've got two types of dependents. First, you've got a qualifying child, and then you've got a qualifying relative. And so when we look at those two terms, then you've got to ask yourself, what is a qualifying child and what constitutes a qualifying relative? So let's look at that in more detail. So first of all, a qualifying child. All right, there's 5 tests that have to be met for a child to be a qualifying child in order for you to take a dependency exemption for them, okay? First test, there has to be a relationship between you and the child. So it could be a son or a daughter, stepchild, foster child, or a descendant, like a grandchild or something like that, of any of those previously mentioned. Could also be a brother or sister, half-brother, half-sister, or a descendant of any of those previously mentioned as well, okay? An adopted child is treated as a natural child, so if they're adopted, they're regarded as a child, okay? So that's the first test, and all 5 of these tests have to be met in order for this to be a qualified child, okay? Second test is the age test, all right? They have to be under 19 at the end of the year, or they have to be younger than you or your spouse, okay, if you're filing a joint return. Now, I don't know why that's in there, but certainly it has happened, I guess, before. If, for example, they're a full-time student, well, then they have to be under age 24 at the end of the year. And again, they have to be younger than you or your spouse. Also, if they're permanently and totally disabled at any time during the year, regardless of their age, they will qualify as a qualifying child, okay, as long as there's a relationship, you meet the relationship test and these other tests. So if it's a handicapped type of individual that is permanently handicapped or disabled, there's no age test basically on that. That's what we're saying. All right, so those are the first 2 tests. The third test is the residency test. The child has to have lived with you for more than half the year. Now, there are some exceptions to that. For example, if a child is away from school for a good portion of the year, they're considered to have lived with you if they're a full-time student and stuff at school. If they're kidnapped for some reason, then they're considered to have lived with you. If there is medical problems and they're in a hospital for a good portion of the year, they're considered to have lived with you during that time. And there are other exceptions as well. So just be aware of the main rule is that they have to live with you for more than half the year. But be aware that there are exceptions, okay? Then the 4th rule is a support test. So taxpayer, or you in this case, have to have provided more than half the support of the child during the year. Now this one's a little stickier, and we'll talk about it a little bit more near the end of this video because in order to figure out whether you've paid half the support, you need to figure out what the total support was. So we'll talk about that. And then the joint return test. The child cannot have filed a joint return for the tax year with anybody else other than to claim a refund. So if the only reason they're filing a joint return is to get a refund back, that's permissible. But other than that, they they cannot do it, or the child is not a qualifying child. All right, so this is pretty easy actually to meet. I mean, if for example you're married and you have a child, there's been no divorce situation or anything like this. This child is a natural child of you guys. Well, then you meet it easy, and so the dependency exemption is very easy in most cases. But like I say, it gets much more complex if there's been a divorce or a death or something like that. So let's go and look at what the qualifying relative is. Okay. Qualifying relative has 4 tests, basically. There's not an age test for a qualifying relative because a qualifying relative can be any age. So your first test is whether or not this is a qualifying child. If it's a qualifying child, well, then it cannot qualify as a qualifying relative. Okay, so your first test is it cannot be a qualifying child. All right, and we just went through the tests on that. Second test is that the person must be a member of the household, or there has to be a relationship. So if the person is a member of the household for the entire year, well, then they don't have to have the relationship, okay? They qualify as a qualifying relative under that particular test. If they're not a member of the household for the entire year, then there's got to be a relationship test, all right? You apply the relationship test, and the relationship test is you look at how these people are related, and they can be related in any one of the following ways. So child, stepchild, foster child, much the same as what qualifying child is, but they can also be father or mother, or a grandparent, or another direct ancestor, okay? Stepfather, stepmother, that type of thing. So you see, these are the relationships that would qualify for the relationship test, and in this case, they don't have to have lived with you for the entire year. All right. So be aware that this test is a member of the household test, or it's a relationship test. Now let's look at the other 2 requirements. First, the gross income test. Okay. A person cannot have earned more than $4,300 for the year. Now, this figure changes every year. It goes up a little bit with inflation. So the $4,300, I believe, is for 2021. But that's not a lot of money. So these are individuals that have retired, or they're handicapped, or they don't work, they don't have a job. So a person is not going to qualify as a qualifying relative if they make very much money at all. $4,300 is the limit. And then let's look at the support test. And again, the support test we'll talk about a little bit later, but the person has to have provided, you as a taxpayer must provide over half the support for the person during the year, okay? And again, in order to figure out half the support, you need to know what the total support was that was provided. And so that's a stickier situation, and we'll get into that just a little bit more. An ex-spouse, for example, cannot be a qualifying relative. So if you've got your ex-wife or ex-husband living with you in your home, even though you've provided more than half the support, and they haven't made any money, they don't qualify as a qualifying relative. All right. And these qualifying relationships, if you have been married and are divorced, and you've got a stepson that is living with you from that marriage, well, the divorce or death doesn't end that relationship. So that relationship continues to go on with those individuals. So I think that's a fairly nice way to do it. I mean, if you do have stepchildren living with you and your wife has to die and they were her children, you can continue to qualify them as qualifying relatives. Or even in a divorce situation, if they continue to live with you, they'll be a qualifying relative if they meet the other tests. So that's the qualifying relative test. A little bit different than a qualifying child test because there is no age limit, but there is a gross income limit on this one. So look at that. Now let's look at the support test just a little bit more. All right. This first paragraph is off the IRS website. It basically says that support would be includes amount spent for food, lodging, clothing, education, medical and dental care, recreation, transportation, similar necessities. So all those things would be examples of support. There are things that aren't support, for example. But I mean, if you're paying somebody's taxes for them, that's not support. So you've got to be paying something that actually supports them in their living conditions. Okay, and if, for example, you have a qualifying relative living with you, or a relative living with you, and you have 4 other kids, and this is the 5th one, and you want to write off the food, well, then you have to take 1/5 of the food to that qualifying relative. You can't take the whole thing. So there does have to be some apportionment or some allocations here for some of the things in the home. And that would be the same thing for rent and things like that for your home. That's providing for all the family members in the home. All right. There are situations where nobody meets the support test, at least over half the support for the year. And in that case, multiple support agreements are available. In order to get a multiple support agreement, you file Form 2120. And what happens with these agreements is that the parties that provided the support have to get together and they have to say, okay, we are going to allow this particular person to take the exemption this year. Okay. And so Form 2120 actually states that, and it has to be signed off by the other parents that have provided some of the support, and say, okay, we're letting this person have the support this year. Also, if there's a support test for children of divorced or separated parents, and in this case, if a child doesn't qualify as a qualifying child of either one of the parents, well, then they may qualify as a qualifying relative. And so Form 8332 documents that decision, and it requires the person that's giving up the exemption to sign off on that, and could be the non-custodial parent claiming the exemption, but Form 8332 has to be filed, and the custodial parent in this case would have to sign off on Form 8332. Both of those forms, whether it's a multiple support agreement or a divorce situation, have to be signed off by the other parties. Okay, so the difficulty here, I mean, this is the dependency exemption is very easy for most people. I mean, if you've got a family where you've got a husband and a wife and biological children from that family, then it's very easy. I mean, you just count the kids, and they've lived with you all year long if you're raising them, and there you go. But some of these other situations where you might have a relative living with you, or you might be supporting a grandparent, or a lot of other type situations, a divorce situation, it's not really cut and dried. So you need to be aware of what the rules are so that you don't claim an exemption that you don't deserve. And another thing that I see quite a bit is that, especially in divorce situations, a lot of times one of the spouses will file the return early, and they will claim the child, even when they should not claim the child, but they will claim the child on their tax return, list the Social Security number, and by the way, you do have to have Social Security numbers for these dependents. And then when the person that deserves to have the exemption files their return, it kicks out and says somebody's already claimed this individual. And then you have to get into it with the IRS to show that you should claim the individual instead of the other person. And so what happens a lot of times is the person that files first gets the exemption, and whether they should or not, unfortunately. But you need to be aware of that. I mean, because the IRS does check these Social Security numbers, and if they're on more than one return, the second return, the later return that's claiming them, is going to kick out of the system, and it's not going to be allowed to be electronically filed. It's going to be kicked out, and then something is going to have to be done before the return can be filed. So kind of a difficult situation. We run into that a lot, actually, as CPAs or as enrolled agents or anybody that's a professional tax return preparer. So just be aware of that. Thanks for watching. There are issues here that you need to be aware of, and hopefully this clears some of them up. If you've got questions, put them in the comments section of the video, and I do try to answer all the questions that I get, so feel free to ask me anything, and I'll try to answer the question. And again, I appreciate you for watching. If you haven't subscribed yet, go ahead and hit that subscribe button and subscribe to the channel, and you'll get notification of all the new videos that are coming out. Thank you very much.